Morning everyone, my name is Jaren Cardente and I will be the first reporter for the first topic of chapter 5, which is working capital and cash management. So here are the objectives for this chapter. First, define working capital and the related trade-off between profitability and risk. Compute for the cash conversion cycle, its refunding requirements and the key strategies for managing it. Manage receipt and disbursement of floats, including speeding up collections, slowing down payments, cash concentration, zero balance accounts, and investing in marketable securities. Appreciate the use of different techniques in working capital management, and compute and explain the cost of discount forgone. So, working capital. Working capital is the difference between the company's current assets and current liabilities, and it used to check the company's liquidity. So, if the company's current assets are greater than the current liabilities, then it is capable of paying its current obligations. Conversely, if the current assets are less than the current liabilities, then the company cannot pay its current obligation and has to resort to borrowings. The current assets comprise cash, accounts receivable, market securities, inventory, and prepaid assets, whereas the current liabilities are the short-term obligations that are expected to mature within 1 year. The continuity of the company operations is ensured if the movement of working capital is properly managed. By having a well-planned working capital, a company can take advantage of business opportunities to achieve its goals and meet its financial obligations. Moreover, proper utilization of working capital is necessary to prevent excessive investments. On the other hand, managing an excessive working capital will have a negative effect on the company's profitability and liquidity due to various factors that are associated with it. So here is an example. The selected assets and liabilities of FLT and Associates are as follows. You may refer this in your textbook. So let's move on. Working capital management. Working capital management is concerned with the efficient and effective utilization of working capital to attain the predetermined objectives of the company relative to the profitability of operations, liquidity of financial resources, and minimization of risks and company costs. It also pertinent to the administration and control of working capital to ensure that it is adequate and effectively utilized. The working capital also regulates various types of current assets and current liabilities. This requires decisions on how the current assets will be financed and utilized. The current liabilities management, on the other hand, implies maximizing the company's holding period before it finally pays off its obligations. The top management determines how much investment should be made in current assets. The investments may change from time to time and requires close monitoring of the account balances. The current assets are not properly managed if funds are tied up in one or several assets that do not provide any return when it could be more productive and beneficial than the company if placed somewhere else. The goal of management is to maintain a minimum cash level without putting the company at risk. Any excess cash could be placed in other investment opportunities such as time deposit, mutual funds, bonds, and capital investments. In managing account receivables, the company should not to be lax or strict in granting credits because being too lenient would result in accounts receivable increases and bad debts, and being too stiff on credit would reduce the accounts receivable at the expense of a decrease in sales. In inventories management, investment on excessive stocking levels may result in obsolescence and losses. Inventories that are maintained at a level that is enough to support the market demand need a great deal of cost saving in warehousing, insurance, manpower, among others. So that is all for my report. Thank you everyone.
Hi, this is Sheila Delgado, and I will be discussing about the working capital policy and how is working capital managed. So let me just first discuss what is a working capital policy. It actually refers to the strategies or practices of the company to employ or manage its short-term asset and liabilities in order to have a smooth day-to-day operation. And this is also to this is actually a policies to also design the to optimize the balance between the cash inflows, outflows, and also to maintain adequate liquidity and support the company's overall financial health. So there are actually three. That is a matching policy, aggressive policy, and conservative policy. So let's just go first with the matching policy. So matching policies, under this policy, it's actually all of the fixed asset and current, or I mean, the permanent asset is actually, they are actually financed by the long-term liabilities and equity. So let's just go to the second one, that would be aggressive policy. And this is actually, it's actually focused on minimizing the amount of working capital held by the company. This is also involves closely managing the cash flows, reducing the inventory levels, and implementing efficient collection practices for receivable. So by operating with lower receivables, or a level of working capital, the company can potentially increase the profitability, but may face challenges as well in managing their unexpected cash needs or the rapid growth of the company. So let's go to the third one. That would be the conservative policy. It actually has the lower risk and lower return. So under this policy, a company is actually aims to maintain a high levels of working capital. So this actually involves holding larger amounts of cash, inventory, and receivable, which provides a cushion for unexpected expenses or downturns in sale. While it can also enhance a financial stability, it can also tie up capital and result in lower profitability. So compared to the other two policy earlier, this conservative policy has the lower rate of the risk and as well as the return. So let's just proceed. The working capital management and the risk return trade-off. So in order to in the working capital management, consideration of the risk return trade-off is actually required. Why is it required? It is because the relationship between the working capital management and the risk return trade-off, it actually requires careful consideration, as what I've said earlier. And companies also need to assess their risk appetite, financial goals, and market conditions to determine an appropriate balance. So the industries and companies with greater risk tolerance may pursue more aggressive working capital strategy to optimize profitability, while those with lower risk tolerance may prioritize maintaining high levels of liquidity. And so for overall, having an effective working capital management involves finding the optimal balance between the liquidity, profitability, and risk exposure while considering the risk-return trade-off inherent in financial decision making. So let's go to the next topic, which is how is working capital managed. So managing in working capital is done in numerous ways. So there are actually possible ways that can improve a company's management. There are actually 4. So let me just discuss the first one. So the first one is looking at the financial ratio. So play a crucial role in working capital management since it draws important information that a company may use in order to improve its working capital. And for instance, actually, a company with a high current ratio but a low quick ratio gives a high investment in inventories. But a high investment inventories does not necessarily have a bad impact of a company's profitability, but it actually has a high return. So, however, if a company has a high level of return, inventories but low turnover, it indicates that the company is not creating sales. Okay, the second one is putting up a proper internal control. So why we need to have a proper internal control? It is because without having a proper internal control is actually regulates could be avoiding, if not totally eliminate that. So under this one, proper internal control of cash averts staff mishandling or misappropriation, and proper internal control of inventories. It also prevents unauthorized releasing of goods from the warehouse, and as well as for having a proper internal control of receivables, it's actually disallowed the non-recording of cash collection. And yeah, having a different units of the organization, it's also take part in a control process. So, and each unit has its actually own control measures to curb any irregularities that might be affect the working capital of a company. So, the third one will be changing the company policies. So, policies serves as the guidelines in executing the transaction and activities of a company. So, why we need to have a guidelines in our company? Because it's actually very important to know that all of your employees is actually aware of that one, and as well as they know what is actually the goal for the company is to gain profit, like that, and to follow those guidelines to avoid any mishandling of the cash or any theft like that. And however, if the existing policy does not contribute to the general welfare of the company, changing it will be a better option. And for instance, continually declining sales may be resolved as well on that one for not being competitive in giving credit terms. So there could be a circumstance as well if the current guidelines of your company is not affected to gain more sale or to gain more profit, then you need to change it that can definitely benefit the company. And the last one is preparing the budget. So in preparing the budget, the company can clearly identify the time when additional working capital is required or when it has excess working capital. So in this one, throughout this budget, the top management will also have a clear picture of what activities they could undergo in a period of time to help improve the company's performance. So this is actually, they will most likely the company, or actually the companies is actually preparing the budget throughout the year. And that is for my report. Thank you so much. Bye-bye.
Good day everyone, I am Christine Bilapil and I will be talking about cash management. We all know that cash is the lifeblood of a business, and a business needs to generate enough cash from its activities so that it can meet its expenses and have enough left over to repay investors and grow the business. So while a company can fudge its earnings, its cash flow provides an idea about its real health. So with that definition, we can ask the question, kung anong important ang cash management sa business. So why is cash management important? To answer, Cash management is the process of managing cash inflows and outflows. This process is important for individuals and businesses because cash is the primary asset used to invest and pay any liabilities. Cash management not only provides entities with a window into their financial situations, but it can also be used to improve their profitability by fixing their liquidity problems. Mismanagement of cash deprives a company of the opportunity to do more. What are the reasons why we need to maintain cash? So first reason is transaction motive. This refers to the company's intention to meet the minimum business operations requirement. The cash balance should be enough to pay for the routine payments, kanang transactions in the usual operations. So with this motive, the cash collections must be immediately deposited. On one hand, fluctuations between the collections and disbursements result in changes in requirements. On the other hand, ang shortage sad sa cash collections would result to borrowings, and if ever na ay excess funds, kay pwede siya invest sa marketable securities. Second reason is speculative motive. So this leads to the use of cash balances to take advantage of bargain purchases on materials or unusual cash discounts. Kanina reason kay it holds the idea that the future is uncertain. So for example, mag-forecast ang firm na ang prices sa raw materials kay mo down ni siya sunod because of certain reason. So what the firm will do is to hold cash and maghuwat sila until prices will actually fall. So there is the element of uncertainty. Last reason is precautionary motive. This results in holding cash for unforeseen fluctuations in cash, inflow and outflow. So kani kay para ni siya ma-ensure that the business has a certain reserve to cover any unexpected transactions. So in short, this is money needed for emergencies. Moving forward, we have here cash equivalents. So, and as defined, they are short-term, highly liquid investments that are readily convertible to cash. In accordance with PAS number 7, investments with the original maturity of 3 months or less is qualified as a cash equivalent. So, dapat ang purchase date is 3 months or less before the maturity date. Examples of this include a 90-day treasury bill, a 180-day treasury bill purchased within 90 days before its maturity, a 90-day time deposit, and many others. There are advantages of holding cash or cash equivalents, and it includes taking advantage of the whole trade discounts. This is usually done by suppliers to encourage early payment. Thus, payment within the discount period results in less outflow of cash. So for example, a high-volume wholesaler might be entitled to a higher discount than a medium or low-volume wholesaler. In simple words, a trade discount is a discount that is referred to as a discount given by the seller to the buyer at the time of purchase of goods. Second, we have here maintenance of good credit rating. So if a company na ay good current and quick asset ratio at par with the industry, then it will be able to maintain a good credit standing with suppliers offering favorable credit terms and banks giving low interest rates. This was already mentioned previously nga both current and quick ratios are liquidity ratios which measure the company's ability to pay short-term liabilities. Third, we have favorable business opportunities. In here, pwede i-take advantage sa company ang mga special offers coming from the suppliers. Fourth is meeting emergencies. So, companies may immediately recover losses brought about by fire, typhoons, strikes, and other unexpected events. Last is capacity to compete. So by having enough cash, a company is able to face its competitors by expanding or developing new products and many others. Next is factors affecting cash requirements. First is company policies on cash management. So it is important to establish guidelines that govern how money is spent. So how it is saved and how it is invested. Reason nga no na ay internal control in order to monitor the cash nga actually needed to cover certain operations. Second, we have availability of loans, which is very understandable. Kay a company with a good credit standing may hold a cash balance at low levels without putting the business at risk. So funds are always available when the need arises. Third, we have forecasted cash inflow and outflow. Specifically, cash flow forecasts estimate the amount of cash going into or out of the company. So if mag-forecast sila about inflows and outflows and the factors that affect both, such as fluctuations, then they will be able to prevent shortage when such case happens. Last, we have unpredictable events. By estimating unpredictable events, the company will be able to save a lot of time and money. Moreover, not meeting any unpredictable increase in demand for the company products will result to its opportunity cost. So opportunity cost represents the potential benefits that an individual, investor, or business misses out when choosing one alternative over another. Next is possible placements for excess cash. First is savings and or current accounts. These are bank placements with no holding period. So, naani siya downside ang savings, which is ang interest na ma-earn sa placements kay lower kaysa sa time deposits. With regards sa current account, kay mas lower ang yang interest na gi-offer compared sa savings. Second, we have time deposits. These are placements with a holding period and are offered by banks that earn higher interest than the savings account. Third is stocks. So these are shares of stocks traded in the formal stock exchange and bought from stockholders. However lang, this entails costs which include broker's commission, government taxes, and documentary stamp tax. Fourth, we have treasury bills. These are short-term obligations issued by the government and are usually offered with a maturity of 91 days or in some cases, less than a year. So these are traded at a discount basis pero dili nimo ma-earn ang interest until the maturity date. Ang maturity value kay less sa discounted value will be the profit earned for investing in treasury bills. Lastly, we have commercial papers. These are unsecured promissory notes issued by companies with high credit ratings. In addition, no collateral is offered by companies that issue the commercial papers because of the company's good track record of cash inflows.
Hello, good morning everyone. I am Sheila, the next reporter, and I will be reporting about controlling cash flows. So the main objective of the cash management is to control the cash flow. So tools to control cash flows are as follows: synchronizing cash flows on, payments, collections, extending cash payments, availing of cash discounts, and lastly, the optimum transaction size. Synchronizing cash flows, this means the process when cash inflows coincide with the outflows. So it means that all inflows and outflows must be on the same amount. So it is highly dependent on an accurate forecast of inflows and outflows. Next is floats and disbursements. So this is the differences between the company's book and bank account balance in any period. So floats and disbursements exist when a company issues its own check and sends it to a payee company. A float can be classified into three categories. First is the mail float, second is the processing float, and lastly, the clearing point. Next would be accelerating collection of funds by reducing collection floats. So collecting center or agent. Collection of funds involve collecting center or agent. So this can be reduced by strategically locating a collection center near the customer. So the collecting center can be a company providing a collection service or can either be a bank payments made directly to the company's account. And here is an example of Cunanan Corporation. An analysis of their problem is as follows. The amount of cash collection per day amounting 3 million. Since we have a number of days freed in the collection, which is 1, so the amount of cash freed is 3 million, less the increase in compensating balance of 500,000. So we have a total increase in the cash flows of 2,500,000. And since we have a 9% rate of return, so the increase in cash flows multiplied by the 9% rate of return, we have an incremental income of 225,000. What is a lockback system? When we say lockback system, it is a system that gives a company a PO box number addressed. All collections made by the customer will be directed to a PO box that is rented in a postal office. So it is normally managed by the banks, And usually the bank employee goes to the post office to empty the postal and immediately deposits the customer's check payment. And that would be the role of the lockbox system. Here is an example of Cunanan Corporation that has an average cash receipts of 150,000 per day. Normally, it takes days from the time the check is received for it to be made available as cash. So how much cash is tied up? Since we have an average cash receipts per day of 150,000, we have a number of days tied up, 7 days, and then 150 multiplied by 7 days, so we have an amount of cash tied up, a total of 1,050,000. And here is the last example from Cunanan Corporation. And the cost-benefit analysis is as follows. Since we have an average cash receipts per day of 450,000, a number of days cash is freed is 3 days, so the amount of cash freed should be 1,350,000. Since we have a rate of return of 12%, so the 1,350,000 multiplied by 12%, so the expected rate of return would be 162,000. Last to the cost benefits of lockback system, which is 120,000. So our net advantage of availing the lockback system would be 42,000.
Concentration banking refers to a financial practice in which a business or organization consolidates its funds into a limited number of bank accounts instead of maintaining multiple accounts across various financial institutions, and the company centralizes its cash holdings into a similar number of accounts typically held at a single bank or few selected banks. The primary objective of concentration banking is to streamline and optimize cash management processes by reducing administrative burdens and enhancing control over funds. By concentrating funds in a limited number of accounts, businesses can more effectively monitor their cash positions, facilitate cash flow forecasting, and potentially earn higher interest rates or fee discounts based on the aggregated balance. Concentration banking also is often used by the companies with a geographically disparate structure, multiple subsidiaries, or numerous banking relationships. It allows for efficient cash management by consolidating balances from various locations or titles into a central account. Funds from different sources, such as customers' payment or disbursements from subsidiaries, are collected in a centralized account before the being. So next is the continuing cash disbursement. What is cash disbursement? So the word disbursement in accounting means to send out. A cash disbursement is a payment that may be made using currency but can be made in other forms of immediate payment, such as a check, e-check, ACH, digital payment, or another form of payment that immediately deducts the amount of money from your account, explains accounting tools. Some forms of payment, such as checks, might take 2 or 3 days to clear your account, but once transaction is started, you no longer have no access to those funds. A cash disbursement is the outflow of cash paid in the exchange of the provision of goods or services. A cash disbursement can also be made to refund the customer, which is recorded as reduction of sales. Yet another type of cash disbursement is dividend payment, which is recorded as reduction in the corporate equity. A cash disbursement can be made with bills or coins, a check, or electronic fund transfer if a payment is made with a check, and there is typically a delay of a few days before the funds are withdrawn from the company's checking account due to the impact of MO float and processing float. So these are the ways of cash disbursement. So first is the playing the float. So the term playing the float typically refers to a strategy employed by individuals or business to take advantage of the time it takes for funds to be processed or cleared in financial transactions. In the context of cash disbursement, playing the float involves delaying the payment of funds for as long as possible benefit from the interest investments gain that can be earned during the period. Here's a simplified example to illustrate how playing the float works in cash disbursement. Let's say a company needs to make a payment of $10,000 to a supplier, Instead of making payment immediately, the company delays it by a few days. During this day, the company keeps the $10,000 in the interest-bearing account or invests it elsewhere. Depending on the interest rates or the investment returns, the company may earn some additional income during the period. Finally, just before the payment is due, the company initiates the payment and the funds are disbursed to the supplier. By playing the float, the company gains the advantage of earning some extra money while still meeting its payment obligations within the agreed time frame. It's important to note that this strategy should be conducted within legal and ethical boundaries, and businesses should follow applicable laws and regulations related to fund disbursement of financial transactions. So the last part of my report is payment by draft. In the context of cash disbursement, typically refers to a method of payment where a financial institution issues a written order known as a draft or a cashier's check to pay specified amount of money to designated recipient. The draft is drawn on the funds of the issuing institution and is considered secure from payment since guarantees that the funds are available. Here's how the process generally works. So first, request. The payer or the individual or organization requests the issuance of a draft from the financial institution and they provide the necessary details such as the recipient's name, the amount to be paid, and any other required information. Second is the payment authorization, and the payer authorizes the financial institution to deduct the specified amount from their account and issue a draft in favor of the recipient. Draft issuance. So the financial institution creates a draft which includes the payer's account information, the recipient's name, the payment amount of the institution's own information. The draft is typically printed in secure paper and made with watermarks or other security features. The fourth one is the delivery. So the draft is either handed over the payer or sent directly to the recipient via mail or courier. The recipient can be deposit or cash draft at their own financial institution. And the last one is the verification and clearance. So when the recipient presents the draft to their financial institution, it undergoes a verification process to ensure its authenticity. Once verified, the draft is cleared and the funds are made available to the recipient. Payment by draft is often used in situations where a secure and guaranteed form in the payment is required. It is commonly used for large transactions such as real estate purchases, where cash or personal checks may not be suitable or acceptable. By utilizing a draft, the payer can ensure that the funds are readily available and that the recipient will receive payment without any concern.
So, in continuation, I will discuss the remaining ways to conduct cash disbursement, the cash conversion cycle, as well as the ways to minimize the cash conversion cycle. Third ways to conduct cash disbursement is auto debit transfer. To avail of this kind of service, a company has to maintain a certain amount in their account called average daily balance. This bank service provides a company with two or more accounts to facilitate payments and collections, namely savings account and current account. The master account, which is the savings account, will hold all the collections of a company, while current account does not have a balance to function. With auto debit transfer, you gave your permission to take the payments from your bank account. It is a regular payment that is set up and controlled by you, so you have the rights to cancel or alter at any time. When checks issued by a company and then presented to the bank, the amount to be charged to the current account will be funded automatically by the savings account, made electronically to cover the amount of checks presented. Fourth is debit transfer. It is done manually, usually at the end of the banking day or early in the next banking day. Debit transfer. The features of this service are similar to those of auto debit transfer, but the key difference lies in the fact that debit transfer is done manually, while auto debit transfer is made electronically in such ways that when checks issued by a company and then presented to the bank, the amount to be charged to the current account will be funded automatically by the savings account, while in auto debit transfer or debit transfer,
It is somewhat segregated into two: the debit memo as well as the credit memo. A debit memo is entered against for the savings account of a company, while the credit memo is then made for the current account. It is segregated into, while sa auto debit transfer, the amount to be charged to the current account will be funded automatically by the savings account. However, in debit transfer, it transfers just enough funds to cover the amount of checks presented for payments. Fifth is stretching of payables. This is the process of extending payments to suppliers or creditors. Payments should only be delayed for a time that is tolerable to the creditor. As the name implies, stretch, wherein it involves delaying or extending payments to its suppliers or creditors past the mutually agreed upon due dates. This is beneficial or advantage to those companies who are not capable of paying on time, like marol man gud nila ang ilang kwarta. However, there are some companies who would not agree in this kind of payment, maybe because they want to pay their debts so that they can maximize how much profits they earned, or either it is a gain or loss. But in any economic downturn, companies at some point will consider improving their cash flow by extending the payment cycle, delaying payments to its suppliers. It is therefore stretching of payables gives companies or business more time to pay the bills and extends cash flows. Sixth is centralization of disbursement. Other companies control their cash disbursement by centralizing it. This way, they are able to monitor their payments and satisfy their obligations to the optimum time. Centralization of disbursements allows a bank's corporate clients to see their expenditures or disbursement on a daily basis, which is a controlled period of time. Companies can select creditors who must be paid first and extends payments to those who can tolerate delays, because companies are also keen on selecting creditors who must be paid first, because there are some who are not capable of paying or who cannot tolerate delays. Like, what if ang iyong gihatagan og delays is not capable of paying on that day? So, creditors or companies can select creditors who must be paid first and extends payments to those who can tolerate delays. Companies control their cash disbursement by centralizing it to speed up collections and slow down disbursements. Last but not the least is the use of statistics to predict the amount of checks issued. By looking at the historical disbursements of a company, one can establish how much funds must be deposited to cover the checks issued. To estimate the number of people who will be making deposits compared to the people requesting loans, business or companies use a statistic to predict the amount of checks issued. Unlike sari-sari store nga, pwede raman dili magkadima ilang inventory sa ilang halin, maybe because the sari-sari store is their primary source of income. So, katugid ilang kuhaan sa ilang mga expenses and etc. However, if you're working in a bank or institutions, we all know that every cent or peso really matters. Through the usage of statistics based on the given data, the company can approximate the funds it needs to cover the check issuance. As an example, salary payment of XYZ company is made every 15th and 13th of the month through issuances of checks. It pays 5,150,000 per payroll. However, based on the historical clearing of checks issued in salary, 50% will present the day itself, 30% will be presented 5 days from the salary date, and the remaining balance will be presented in the 10th day after the salary date. If the interest rate in market is 12% per annum, how much is the incremental income of XYZ company if the entire amount is not deposited? So, as a computation, incremental income from salary date to 5 days from salary date, 5,350,000 times 50% times 12% per annum times 5 days over 360 days per year a total of 4,375. Then incremental income from 5 days to 10th day from salary date, 5,030,000 times 15%. Ang pagkuha niya is 50% less 35%, a total of 15% times 12% per annum times 5 days per 360 days per year, a total of 1,312.50. So a total incremental income of 5,687.50. As an additional information, by not covering the entire amount of the payroll, the company will generate an incremental income of 5,687.50. Thus, the company has deposited only 2,035,000 on the day of salary payment. So, 50% of 5,035,000 is 2,625,000, and then the other 50% can be placed in the market at 12% per annum, with an interest amounting to 4,375. The next deposit will take place on the 5th day from the salary date, amounting to 1,837,500. So 5,030,000, 50% of which is 2,785,000 times 35%, a total of 1,837,500. And the remaining balance of 787,500, less ang 2,785,000 less of 787,500, less ang 2,785,000 less 1,837,500, a total of 787,500, and then place again at 12% with an interest amounting to 1,312.50. By not covering the entire amount of the payroll, the company will generate an incremental income of 5,687.50. As what we can observe, a company opens an account exclusively for those disbursements which do not necessarily cover the entire amount of the payroll or dividend payment. A company has to establish, on average, the amount of the checks to be presented by its employees on the beneficiary of the dividends in order to maximize the cash balance. Next is the cash conversion cycle. In managing working capital, the cash conversion cycle plays an important role in sustaining cash availability to support the profit-generating activities of the company. So as an example, on December 31, BL Corporation reported sales amounting to 9 million. The cost of goods sold and purchases amounted to 7,500,000 and 4,500,000 respectively. BL Corporation has an average age of inventory 60 days, an average collection period of 40 days, and an average of payable of 35 days. What is the cash conversion cycle in days and amount of BL Corporation, assuming that it covers 360 days per year? So, in computation, cash conversion cycle, average collection period of 60 plus average age of inventory, which is 40, less average age of payable, that is 35, a total of 65 days. The computation for the additional funds needed is as follows. Inventory of 7,500,000 divide 360 times 60, a total of 1,250,000. Then accounts receivable of 10 million divide 360 times 40, 1,111,111. So in getting sa 10 million, 360 divide 40 is 9, then 9 million divide 9 is 1 million, then i-add balik 9 million, will come up of 10 million. But I'm not sure if this is the accurate solutions in getting the accounts receivable of 10 million. So next is the accounts payable of 4,030,000 divide 360 times 35, a total of 437,500. Additional funds needed of 1,923,611. The given example is a short cash type of conversion cycle, which is good because it considered a positive situation to the firm's profitability. It expressed how many days it takes a company to convert cash it spends on inventory back into cash by selling its product. The shorter the cash conversion cycle, the more liquid the company's working capital position is. The next subtopic that I will discuss under Chapter 5 is the ways to minimize the cash conversion cycle. Minimizing the cash conversion cycle could maximize the stakeholders' wealth. So these are as follows. Reduce the average collection period by improving the company's policy when offering sales and account and improving the company's collection practices. Second is reduce the company's average age inventory by means of improving sales, monitoring inventories, and avoiding maintaining too many inventories in hand. And lastly is extending payment to suppliers without increasing the company's credit risk. For me as a student, I would not or dili pa gid ma-appreciate ang minimizing the cash conversion cycle. However, prior to my own understanding about cash conversion cycle, it is an important business metric that shows how efficient a business is. Tracking it allows a business to see how quickly it is converting cash in sales and back into cash. So through the usage or ways to minimize the cash conversion cycle, it is somewhat helps the business owners to have a clear picture of their cash flow position. That would be all for my part. I am Kimberly Jane Bisismore, leaving you with a quotation that says, "Whatever will be, will be. The future isn't ours to see. Don't worry."
Good morning, everyone. I am Joanna Martugade, the last reporter for this chapter. So let's now proceed for the cost of foregoing a cash discount. A cash discount is categorized under a short-term financing, but however, for the purpose of this discussion, it will be included under cash management. A cash discount is offered by suppliers of goods to the purchasers in order to encourage them to make an early payment. Not paying within the discount period is an opportunity cost for the company. A company that does not fully know the cost of a discount typically makes or takes advantage of a discount offered by the creditor because of the attached opportunity cost. However, going beyond the normal understanding of the term cash discount will make a difference. The credit term is a payment term where credit is granted to the customer. Its benefits include the credit period, the cash discount offered, and the discount period. For instance, if the term of sale is 2/10 or 210 net 30, the customer will get 2% cash discount if the purchase is paid within 10 days. Otherwise, the total amount of obligation is due on the 30th day. So here is the formula of cash discount. So discount percent over 100% minus discount 100% times 360 divided by final due date minus discount period. So the trade credit is liability arising from credit sales. The seller records it as an account receivable and the buyer records it as account payable. If the term of the sale is 210 and 30, the first 10 days represents the free trade credit and the remaining 20 days represent the costly trade credit. If the buyer does not pay during the discount period, the buyer is obliged to pay on the 30th day. The cost of discount is computed as follows. 2% divided by 100% minus 2.0% times 360 over 30 minus 10. So our cost of discount is 36.73%. It can be ascertained that the cost of a discount, if not availed, will cost the company 36.73%. The cost of discount foregone declines as the net period becomes longer in relation to the discount period. Thus, if the term above has been 210 and N45, the cost discount foregone will be 2.0% divided by 100% minus 2% times 360 over 45 minus 10. Our new cost of discount is 21.04%. So when to avail of discount? Before availing of cash discount, a company should conduct a cost-benefit analysis first. Thus, if the borrowing rate in the market is greater than the cost of the discount, then it will be better not to avail. On the other hand, if the borrowing rate is less than the cost of the discount, it will be better for the company to take advantage of the cash discount. So here's another example. ABC Company is considering the discount on the credit term offered by the supplier. The terms are 410 and 60. At the time the term is offered, the borrowing rate in the market is 12% per annum.
should ABC company avail the offer discount? So for the computations, the analysis is as follows: 4.0% divided by 100% minus 4.0% times 360 over 60 minus 10. Our cost of discount for that is 30.0%. As the cost of borrowing is 12%, which is lower than the cost of discount for GAN, ABC company should avail of the discount. Thus, the company borrow from the bank at a rate of 12% and pay the supplier at a discounted rate. The net advantage of the company from discount is 18%, which is 30% minus 12%. That's all for my report. Thank you very much.